Good afternoon, everyone. We'll be starting now. So thank you for waiting patiently. Today, we have invited Mr. Becker from the family office to share with us more about wealth management. To share more about himself, he has previously headed the investment advisory for Southeast Asia at Standard Chartered Private Bank, managing a team of 20 investment advisors and ultra-high net worth assets. His early passion for investing was fulfilled with over 13 years in senior management roles at Deutsche Bank Private Wealth Management in Asia and Europe, leading global portfolio management products and team with a focus on strategies for equity and multi-asset portfolios. To start off, we'll have a poll to test the level and to get an understanding of the level of knowledge on wealth management. So kindly fill out the poll. Mr. Becker, you can see the results on your side, right? Just to check.
No, I've only seen the questions. I see poll in progress, okay. But it's okay. It looks like the poll is still in progress, or is there a delay?
Yeah, I'll be ending the poll now, and I'll share the results. So about half of us here is completely new here, and about roughly half of us has some basic understanding.
Okay, that's good to know. Cherise, you had a few other questions, because I think we asked those before basically I kick off to get a bit of a color of what the expectations are that we're synchronized.
Yeah, and now it's a poll on your interest. So please poll and show like what you're interested in. So Mr. Becker here would know what to focus on more on later. I'll be closing the poll in 5 seconds, so please poll. About roughly half of us here, about 70% of us are very interested in career in wealth management. So
okay,
we can do a good sharing on it later. Yeah.
No, that's good. And market outlook also.
Yeah.
Okay. Well, then I suggest I give you a little bit of a color of where I am coming from and why I do what I do. And obviously career in wealth management. I think there are some important aspects for you to consider. Cherise, I can't see myself. Is that normal or is there something missing?
I think because you're using phone, so you might need to swipe right so you can see the video of yourself.
Oh, here we go. Okay, but never mind.
Do you see it now?
Yeah, I see myself now. That's
okay,
good.
That's great.
Well, yeah, thanks for showing interest. Thanks for dialing in. Yeah, my background is really that of effectively 30 years in private banking, investment advisory, and I've seen a lot. I've done a lot, and currently we're in a bull market, which on a certain level is wonderful because a bull market means rising prices. And I hope that some of you are participating in this, although you're very early in your career and potentially don't have money to invest or only limited money. But a bull market is wonderful. The problem is with a bull market is also distorting information. A lot of the things that you see now and maybe something that you've seen last year is quite unusual. So you shouldn't take it for granted. But okay, let's go back to the very beginning. beginning. I actually wanted to become a foreign correspondent, and that's why I studied Chinese and politics and history. But I guess probably because of family interest and the fact that I had some money to invest because my father passed on a bit too early. There was a small payout from a life insurance, which my mother asked me to take charge of and learn about investing. So I dabbled with investing. This time, Charisse told me earlier she has a paper portfolio, but I had the luxury or the challenge to deal with real money. I mean, it wasn't a lot, but obviously money means responsibility. And I came across an independent financial advisor, and this was I think you have these also in Singapore. These are basically um, typically smaller outfits where people advise on life insurance, on unit trusts, and so on and so forth, with sometimes better, sometimes less education. And they're more or less broker organization. So I worked for such an organization part-time when I did my national service in Germany. And that sort of triggered my excitement. From then on, I pretty much subscribed to the Financial Times, read that pretty much every day, and a lot of other newspapers while I was studying. And then there were also some people who were curious about what I was doing, and naturally, there was also a bull market in 1993. I didn't know then that it was unusual, but I was very excited. And some people entrusted me with some money. So while I was at university, I was studying, but also basically investing, and typically investing in stocks because I liked this the best. There was most action, most dynamism. And there was a bull market in 1993. I made a lot of money there, but I didn't know, or let's say from my perspective then, I earned 80,000 Deutschmarks, which is the equivalent of about 80,000 Singapore dollars. And for me, that was a big sum at the time, but I didn't know that it was a bull market. So what happened in 1994, the Fed increased the interest rates by 2 percentage points. And I had gotten very cocky at the end of 1993, bought a lot of warrants, which basically is short-term options in Swiss financial organizations, the predecessors of UBS and Zurich Insurance and so on. So a lot of that 80,000 Deutschmarks disappeared in 1994. And unfortunately, I had to go to Taiwan in 95 to study. So I would have done better keeping some of that money from 93 to potentially have a better student life in Taipei. But I survived on a lot of noodles and a lot of jiaozi. And I had a good time regardless. But and I guess this excitement made me drill ever deeper. And I think that's something I would advise you, but I'm also telling my children, I hope for them and for you to identify something that really grips you, that you really find exciting, and the interest to read more, to do more, to learn more. And then I guess based on that context, I also inquired with a gentleman who was then a popular asset manager in Germany, but living in the US, whether I could do an internship there. And I got lucky, could do that internship in New York for 6 months. And that effectively later also helped me to get into Deutsche Bank as a graduate trainee. And then I started there as a graduate trainee. Obviously, my aim was to sidetrack. Actually, my goal of joining Deutsche Bank was actually not to embark on a corporate career, but to obtain a license for an independent asset management shop. Because at the end of my university life, I was managing about 10 million Deutschmarks at the time. And I was wondering whether that was still legal or whether I needed a license for this. And so I inquired with the German authorities, and they told me, they were practically laughing in the phone and said, there's no way somebody like you is going to get a license. So you have to join a reputable entity, stay there for a long time, and ultimately you may qualify for a license. And then that was my objective. But then, I joined Deutsche Bank as a graduate trainee and got lucky again. I mean, you could call it luck, or you could call it perseverance, or you could call it creating a context. But My then girlfriend was transferred to Jakarta, to Deutsche Bank Jakarta. In those days, banks really had a lot of money to spend. Unfortunately, this is no longer the time. But there was a program when Deutsche Bank staff was allowed to travel into another country, into another branch, to learn about how the bank was to go about things in that country. So she went there, and I basically met the head of private bank Indonesia, who in turn introduced me to the head of private bank Singapore. And all of a sudden I had a job in Singapore, and that was in 2000. So I had my first stint in Singapore. I was, since I had a lot of equity experience, I was then made sort of an equity strategist, helping the relationship managers. And in those days, actually, there were no investment advisors. Nowadays, each private bank tends to have investment advisors alongside relationship managers. In those days, there were only relationship managers and product groups. So I was then responsible for anything equity related, and then helped the relationship managers. But my boss then got promoted to be global head of product management in London, and he asked me to join him. So I was only in Singapore for 2 years and then moved to London. And the objective there was, and this is still very much what I'm trying to do, is to create better investment advice. At the time, the situation was that if a client came to Deutsche Bank Singapore, he would be told a totally different story from Deutsche Bank Hamburg or Deutsche Bank Geneva or Deutsche Bank New York. And we were looking for ways to synchronize the investment advice. And at the same time, we wanted to have better reporting for clients. And yeah, so I moved to London with the objective of rolling this out in continental Europe, outside Germany, and also Asia. So my link to Singapore and Hong Kong was still there. And yeah, we finished the project. I mean, I could tell you in detail all complications, but in the interest of time, let's not do this now. And then, yeah, then the project was finished, and I had an opportunity to either go to Deutsche Bank Geneva to work as head of portfolio solutions, i.e. helping relationship managers and key clients to have better portfolios, make proposals on wealth structuring and so on. But I didn't see myself move to Geneva. I was not keen on living in Geneva. And luckily there was an opening in Deutsche Bank Shanghai, because again, that was another bull market in 2007. Equity markets in China and also in Hong Kong did very, very well, 2006, 2007. And a lot of Deutsche Bank staff didn't want to move to Shanghai. So these colleagues in Hong Kong felt there's no career opportunity for them in Shanghai. At the same time, the management in Hong Kong knew me, and they knew that I was keen to live and work in China, at least for a while. So they asked me, and I took on this role for 2 years, being head of product management in Shanghai, and helping to roll out the product platform there. That was then finished in 2008. Then I came back to Singapore, and yeah, then something happened that can happen in your future career, and you should brace yourself for that. I got fired, and because there was a restructuring, people thought I was not part of what they were looking to build. This is something, well, I'd say you have to brace yourself for that. I hated it at the time, but at the same time, there's always room for new opportunities, and lucky, in hindsight, luckily that happened, because then later I ended up at Standard Chartered, met my wife, and yeah, and had a wonderful time. Initially as senior investment advisor for wealthy individuals in Indonesia and Pakistan and the Middle East. And ultimately, starting from 2011, I was then head of investment advisory. One reason why I joined Standard Chartered was coming back to this dream of having my own license, my own business. I felt that after Deutsche Bank, I had a lot of product management and portfolio management technical experience, but I was lacking the day-to-day client engagement, which is why I felt I needed to stay in the industry as an employee and as an investment advisor, because that way I was able to talk to clients day by day. And but then, yeah, as history, or as life goes, there was also an end to this story in 2017, late 2016, early 2017. And there was another restructuring. And I mean, you have to, again, brace yourself for that. If you're very senior, if you're a managing director, there are people who either want your job or either want your budget and are looking for ways to get rid of you. And yeah, so that happened again. And this time around, there was no more reason not to go it alone, because by that time, I felt financially secure. By that time, I had enough experience in terms of product management, portfolio management, and also client engagement, which is why I decided to go independent. What we do, you may not know this yet, because earlier you said you're reasonably new to this whole industry. It's highly regulated. So not everybody is allowed to do this, and only people who have sufficient qualifications are allowed to do it. We have a so-called capital market services license. This is a fund management license that requires 2 senior and experienced individuals, plus compliance infrastructure and a certain equity injection. So you can't just go out there and say, okay, I'd like to have my license, I want to do this independently. You need to have a little bit of a plan and resources and network. And luckily, my deputy from Standard Chartered decided to join me, and she's the second executive director next to me, and that's how we started the business. I incorporated it in June, and yeah, indeed, it's called Das Family Office. So don't confuse it with the Indian surname Das. At the same time, that Indian surname may have helped with the incorporation, because initially I wanted to incorporate the name The Family Office to basically express the ambition to be a relevant, credible player and a high quality player in the Singapore market. But this is a very generic name, so I was not allowed to incorporate this. And cheeky as I am, I tried Das Family Office, which is German for The Family Office. And I got away with it. And probably only because the people who did the incorporation thought it was about an Indian family, and that would make it non-generic. So thank you very much, Family Das. You basically made it happen. Okay, yeah, that's basically about me. And maybe before we move on to something else, the big difference, and that's also one reason why I wanted to go independent, is and also for your future career planning, there are 2 main advisory models, or there are 2 main private banking investment advisory model. One model, and that is the most common model, I would argue it's probably about 90% of service providers, maybe 95. It is a brokerage model. That means whether you talk to an independent financial advisor, whether you talk to an insurance salesman, whether you talk to a branch banker, whether you talk to a priority banker, whether you talk to a private banker, or whether you talk to a private wealth planner, they all want to sell you something. So they call themselves advisor, but the ultimate goal for them is to sell you something, because this is how they get paid. If they don't sell you anything, they cannot get paid. And I find this is really problematic. In 2015, I had a bit of a very frustrating moment. I thought markets were bad, clients were not making money. We had a lot of pressure on us to sell more product. And I was thinking, who's actually benefiting from this? The bank is not benefiting, we are not benefiting, the client is not benefiting. There has to be a different way. And this is why our service offering, and also the service offering that maybe we can talk about later, it's a wealth advisory platform I've created in Germany. It's all fee-based. That is to say, clients pay us. So we are basically like a lawyer. We're like a doctor. There's no other income stream other than what we invoice the client. And this puts us right next to the client and not opposite from the client. And this model, if you ask me, is already well established in Switzerland. It's well established in America and Australia. But in Singapore, I think this model is only now gaining some traction, I would argue, even if it's still very minuscule. But I think this has to be the model for the future, because clients are also learning. The clients who knew little about private banking 20 years ago now also have 20 years of experience, and they deserve better service, better advice, cheaper advice, better outcomes, most of all better outcomes. My biggest frustration was that, let's say if you go to a restaurant, you can easily say this is good food or bad food, or you go to a bakery, you know, this is good bread or bad bread. But how do you evaluate the quality of a private banker, or of a bank or an asset manager? I mean, maybe that could be another polling question actually. But if you ask me, and that is also my aim, our product, our service has to be performance. That has to be risk-adjusted performance, in a way that has been explained well to a client, so that if a client embarks on a journey with us, he more or less knows the direction we're heading together, so that he always knows what the outcome should be, and can track the day-to-day activity against a credible benchmark. And this is what we do, and this is where we, I think, very different. What's a bit problematic about the term family office, it can mean everything and nothing. There are normal independent asset managers who used to work in private banks. They call themselves family office. There are asset managers who used to call themselves asset management. Now they call themselves family office because it sounds maybe a little more apt, a little more timely. But if you ask me, a family office in the traditional sense should be a group of people that are really dedicated to help either one family or a group of family or a group of individuals to have better financial outcomes. Okay, I've been talking a lot, maybe too much. Cherise, what are you recommending? Shall we do another polling question, or shall we do Q&A? Or shall I show you a couple of slides that I've prepared? What would you recommend, Cherise?
So we have another few more polls before you go on to presenting. Would that be great?
Okay.
Okay.
Yeah, I've prepared a couple of questions for you. So I'm curious how you will answer those.
You have 30 seconds for this first poll on global clean energy sector. Closing in 5 seconds. The majority here has agreed that investors in global clean energy sector will earn double-digit returns in coming years.
Very good. Next question.
The second question will be on Bitcoin, the US dollar. I'll be closing the poll in 5 seconds again. Ooh,
Okay.
a very
That's
strong
also
93%.
Also quite clear. Okay. I'm quite comfortable with that answer.
The third question. I'll be ending the poll in 5 seconds. Majority feels that emotion is the most detrimental factor. Okay. On to the fourth question. Ending in 5 seconds. We have a tie between 6.8 and 10 to 15%.
Can I see that?
Yep.
Okay,
For the
okay.
investment return, about a tie. On to the fifth question. I'll be ending it in 5 seconds again. Oh, about half thinks that it's between 5 to 10%.
Which is kind of what I expected, but unfortunately it's not true.
Yes. And on to the last question. I'll be ending the poll in 5 seconds. The last question has very varied results.
Okay, interesting. Have a little more faith, friends.
I'll start sharing the slides now.
Yeah, maybe we start with the first one because let's start with the slide on the clean energy chart, because I think there's a conviction in the group that clean energy will have double-digit returns in the next several years, and I purposely brought this question up because time and again, and that's why I said earlier, there's always that a bull market distorts price information or information overall. And I've brought a chart. Actually, I brought 3 charts for you, or three extracts from Bloomberg on this item. The very first one is, you see those 3 slides, Charisse, at the end of the towards the latter part of the presentation. Let me give you the number.
Yeah, give me
You
a
found it?
second. Is this the right slide?
This one is the right slide, yeah.
Okay, great.
So here you can see the global clean energy, and that's probably why you say this is going to go up, because people have a tendency to just stay with a trend, and trend is not wrong. There's certain merit in momentum, but if you look at my next slide, the question is, how much do you now have to pay for global clean energy? And you will get all the slides in the end, but here this is very small. This is a table that shows the current valuation of the global clean energy segment, yeah. And I'm basically saying this is very expensive. The current price of this sector is as if you were to buy chicken rice for 500 Sing dollars per plate, yeah. And I think that's really dangerous. And that's what happens in a bull market, because everything is so exciting. There's euphoria, especially if you've already been in the investment and you think it's going to go higher. What you must not forget is that ultimately you're buying a share in a company. So I'm not a fortune teller, and I actually don't really provide a market outlook, but rather market context. And the current market context tells me that you're buying your clean energy at a very high price. And now let's go to the last slide of this one, because we've seen this before. And what I found interesting, because I've been seeing that in so many chat rooms, that a lot of young investors, novice investors, people who have never invested, they find it intuitively attractive to buy clean energy, because naturally the world needs clean energy. But that's not to say that it's going to be a great investment for you. And you could see that in 2006, 2007, that same, the chart here displays an ETF, an iShares ETF on clean energy. So you could see that this particular sector has already been hyped up in 2006 and 2007. And then you saw what happened afterwards, because once the euphoria dies down, once everyone gets off the pill, reality kicks in, and people realize that a lot of companies in this sector, either they don't earn money, and or they are normal, typically engineering companies. There's one very hot stock there. It's called Vestas Wind Systems. It's a Danish wind energy producer. This company has been around forever. I mean, not forever, let's say 20, 30 years. And they're a normal engineering company. And engineering companies don't have the profitability that certain other companies have, that we would probably suggest our clients buy for the long term. And ultimately reality kicks in, and the share prices will reflect that. And I mean, you see that it's still rising, but maybe what you see in the chart before, there could also be a double top. I mean, as I said, I don't know the future, but if you're like Cherise, if you're a novice investor, you think about putting your first money to work, I know you want to do that because it's been rising, but good old Uncle Mario would tell you don't do it. Stick with tried and tested stuff that works in the long term, where you don't have to worry whether there's currently excitement. Buy things that work in the long run. And maybe that takes us to the next question and to the beginning of the presentation. I was purposely asking you about realistic long-term return on equities. Take the slide with the different asset class returns a little bit further. That is slide, this one, yeah, this one, yeah. No, next one, this one with the colors, yeah. No, next one, please. The one with the colors, yes. I've created this. This is the right one. Absolutely correct. Absolutely correct. Most of you actually got this question right. The long-term expected return for a diversified equity portfolio is indeed 8 to 10%. Some of you, or there were still a lot of you thinking that it's 10 to 15%. But here on this slide, we've actually prepared long-term returns for the major asset classes. ranging from low risk, which we specify as dark blue, going to highest risk or highest volatility, which is dark red. And these are typically the equity asset classes. There's a lot of data available from America going back to 1926. And there is a lot of evidence that large cap global equities can deliver about 8% before cost and before inflation. So that 6 to 8 number is about right. We could even kind of pinpoint it towards 8%, but let's not do that. And small companies and medium-sized companies, they tend to have returns in the range of 8 to 10%. So there is good evidence that with small company stocks, you can get towards double-digit returns, and in some cases even a little bit more. The Nasdaq 100, which is a very popular index, has achieved about 13% in the long run, but don't expect 10 to 15%. That's way too high. And the reason why I've created this slide is because most private banking clients have no idea what to expect. They may walk through the door and says, oh, I'd like to have 15% with principal protection. The most ridiculous thing I've heard was in Shanghai. It was in the bull market 06, 07. A client told me, oh, you create structured products. Can you please create a product that has 100% return with no risk? I mean, obviously, and he was not joking. Yeah, he was not joking. And it's very important for me that clients and the people I work with, people I sit across or next to, better say not across, that they get the context, because that takes us actually to the next answer that you got perfectly right. Because feelings, greed and fear and emotions, they're far and beyond the biggest distractor to long-term investment success. And I think it's very important that investors know the context, that stability only comes from maybe government bonds and really, really safe corporate bonds, and that high single-digit or maybe double-digit returns can only be obtained by taking equity risk. There is no way to look at this differently. And unfortunately, the private banking industry, and I know you're very keen on this, they sell a lot of what here we describe as yellow and green, something that feels like high returns, but is not equity, or something that is safe, but still delivers 5-6%. And unfortunately, this is not true, and it's not working. And banks offer these products because they allow to hide commissions in derivatives and so on and so forth. It has nothing to do with good portfolio construction. You will get this slide deck, so I don't think we have to go through everything. You can look at this in peace. I will leave my email address. We're also in Singapore. If you guys want, we can have breakout sessions and we can continue the discussion. So we don't have to go through the slides, but I find it very important that investors understand the context. If they don't know the context, they're left alone. And unfortunately, I'm not sure if I'm allowed to say that, but unfortunately, 80% of the private bankers don't know this context. Yeah, they leave themselves in the dark through ignorance, and the banking organizations also don't try very hard to lift that veil of ignorance. So, but I think you can do it better. You're the next generation of private bankers. What you didn't get right in that answer, it was cost. You said it's greed and fear, which is true. I think that is the biggest detrimental factor. But now that you know that, let's say like the longest term return expectation should be around 6 to 8%. Now, what would you say if I tell you that most diversified equity products that you get to, that somebody offers to you through a bank or through an advisor costs annually between 2 and 3%. So you're basically taking 8% equity risk, or let's say you take equity risk, can expect realistically not much more than 8%, but you have to hand over 3%. So that's 40% of your target return. This is a lot. So you got to be really, really careful with how you yeah, how you look at costs and look for platforms where you can reduce costs, because unfortunately there's not much more to earn than 8%. So better don't spend 3% on annually, right? This is not a one-off, annually on certain investment products. But I mean, yeah, I think greed and fear is the biggest aspect. And let's say even if you get costs right, in Germany, for example, there's a lot of hype about low-cost ETFs, that you should only pay 15 basis points on a MSCI World ETF, which is correct, and I wouldn't say this is something to ignore. But if, let's say, last year March you had purchased that cheap ETF with very little cost, but if your emotions got the better of you and you sold it in March, then even the cheapest ETF cannot really help you. At the same time, in those days, it may have been, I mean, I said maybe 80% of the bankers don't know the context, but 20% do. So it may be even better to have one of these 20 good bankers, 20% of good bankers, pay them a little bit of money, maybe not 3%, but maybe 1.5%, and have them guide you through the emotions. And I would argue this is one of our USPs, that we help with this. I mean, we help with costs. Our clients really pay very little compared to what they pay in usual platforms. Although we book them with the usual platforms, our clients are typically with the DBS of this world, the UBS of this world, but we have better terms with them, and they don't have to pay us as advisors. That means it's also cheaper for them to work with us than hire expensive relationship managers. And that's how everyone benefits. The bank benefits, the client benefits, and we also benefit. Bitcoin, I think we don't have to touch on. I'm quite happy that you said it's not going to replace the dollar. So let's ignore this part. Charisse, in the interest of time, I don't know, shall we do Q&A, or should I present a few more slides? What would you think is the best way to go about it?
You still do have time to share a few more slides if you wish to.
Okay. Then yeah, let's go back to this question of the endowment, the $10,000 that your parents may or may not have given you, or that you may already have. I think you got this calculation terribly wrong. It's actually, let's say, if you save for 50 years, this is going to get closer to 500,000 Singapore dollars. So you really should have faith in compounding, in the power of compound interest. If you really, let's say you use a diversified equity strategy comprised of global large cap and global small cap, I think you can shoot for about, oh yeah, let's show you that. These are the slides on the timely and the untimely investment. These ones, yeah, these ones here. I had this prepared because there was an interesting article about the worst investor of all times, and we started this series in 1970. Maybe because I was born there, or maybe because it kind of makes sense, or maybe because you're now in your early 20s and your pension is maybe about 50 years away. What we've analyzed here is that what would have happened if somebody had invested twice every year, always at the peak. So whenever this poor person purchased, the market immediately crashed thereafter. It's really sad. At the same time, there was a second investor who was always smart. He purchased after it had corrected and when it moved back up again. I actually also wanted to ask you this question, but I'll give you the answer. So maybe go to the next slide, Charisse. You will actually see that the best investor of the time made a little bit more than 9%, and the worst investor made about 7.8%. So even, and I think this is also an important aspect for many investors, and maybe also for you now, is now the right time to invest. Because you're afraid, yeah, markets have already gone up, a lot of people are talking about it. So if you look at these numbers and you see, okay, even if I'm that poor sod who always invests at the wrong time, I can still expect almost 8%. That's pretty good, yeah? And even if I would get it right all the time, it's also not massively more. It's just 1% more. I mean, 1% more still is a big deal in a 50-year horizon, but it's not massively more. So I would really, that's another big message, is allow yourself to hop onto that global diversified equity train at low cost, and stick with it. Just write it out. I mean, I've done the same for my daughter. My daughter just started at SUTD. We had put a little bit of money away over the years, and now she has her own online account. And yeah, and she listened to her parents for now and put it into globally diversified equity solutions. And I'm sure she'll do well with this. And I think you will also do well. So don't wait up too long. If there's money that can be stashed away for the longest time, give it a try. And you will also have, Charisse will also, if you're interested, in my German platform, I'm also producing a quarterly review of individual funds and ETFs that we choose for our clients, both in Singapore as well as in Germany. So you can see how they have developed, and then you can check on Bloomberg or which data source you have access to, and actually invest for yourself. I would really encourage you to do it. Time is your friend. Work on your pension when you're 20, not when you're 50. And pension is not going to be a big deal if you start early and start it right. Don't feed insurance salespeople. Don't feed the wrong private bankers. Only feed the right private bankers. And or learn about it yourself. Then you don't have to feed anyone but yourself. And we've done this with other indices. You see, maybe a point in the middle, there's the NASDAQ. The NASDAQ has high, attractive double-digit returns. And I would like to caution you here, because unfortunately, we can only stretch the data back to 85. But the NASDAQ 100 was initiated in 1971. And the long-term return since 1971 was about 11%. So it's not 15. And you should also think that in 1971, the NASDAQ 100 was a small cap index, whereas now it is a mega cap index. So there's a risk that you may compare apples to pears. So for the NASDAQ, I would still rather assume something in the range of 10% than 13 to 15%. What you should also know about the NASDAQ 100, similar to clean energy, it peaked in 2000, yeah, because there was already excitement in 2000. Well, now it's different, I think, because it's not like clean energy. The NASDAQ has a lower valuation, much lower valuation than the clean energy. NASDAQ is probably now like chicken rice at Chatterbox. So it's amongst the most expensive ones in the city, but still kind of agreeable. But clean energy is nowhere near there. But what I was about to say is this, 2000, the NASDAQ peaked in 2000, and it took about 15 years to get back to that. So if anyone bought at the peak in 2000, the return for the next 15 years was about 0.5%. So so NASDAQ, yes, it's a great long-term investment. I think if you look at it for your pension money, fine. But there may be a chance that over the next 10 years, this NASDAQ may just do less than other equity indices. And I have a discussion on this also in that reflections document that you can have from Charisse. I would probably now say it's better to look at global small caps, at least in combination. Maybe you stick with your NASDAQ, but maybe you add some small caps to it. Charisse, what would you say? What else should we touch on? Career opportunities. Are there questions? I'd like to answer questions if possible.
We can start on Q&A, or you could continue with the slides, because we do have time for both actually.
How much time do we have? I thought it was just an hour.
Yeah, we do have time till 6 p.m.
Oh my God.
Yeah.
Well, if there's interest, I will make time.
Yes.
But I also don't want to bore you with lecturing on things that you may or may not find interesting.
Yes, that too. So perhaps we have a Q&A session.
Let me look at the slides, whether there's anything that I haven't touched on.
Okay.
Oh yeah, yeah, yeah. Yeah, I think that's also something we have to talk about is the question on the bonds. I've asked this question purposely also a little bit as a trick question. Um, Take the stress test slide. It's on the stress test. Global financial crisis stress test 2007. That is slide number 12. Your answer on bonds is kind of correct if by that you really only mean very safe investment grade bonds or government bonds. Let's say that the 30-year treasury is really the safest asset in a crisis, and that would go up. And you can also see that here in the global financial crisis chart. The problem that I see in the private banking advisory industry is that most clients say, oh, these government bonds, Temasek, Singapore government, US treasuries, this is so boring. The interest rate is so low. And banks tend to also not recommend those unless the client is asking for it. So what typically happens is clients buy high yield bonds because they carry higher yields, and they buy so-called tier one capital, which are contingent capital. And these are very different bonds. These are not safe bonds. These are not government bonds. These are not high investment grade bonds. These are very risky bonds that behave, I mean, in the case of tier one capital, they behave a lot like equities. And in 2007, they actually collapsed by almost 50%. And high yield bonds, they collapsed by about 35%. So it is very important for you, and ultimately also in future when you're private bankers, to really make a clear distinction in your discussion with clients. What's the objective of this bond purchase? If a client says, oh, yes, I want safety, then you cannot talk about cocoa bonds and you cannot talk about high yield bonds. But if the client says, yeah, I kind of want high returns, I don't like equities, then yes, I think you can talk about that. You still will have to talk about the drawdowns, and you will still have to talk about concentration. But unfortunately, there are bond categories that can collapse a lot in times of crisis. I mean, luckily in 2007, they recovered quite quickly. Within about 1.5 years, they were back at par levels. But again, if you see your bond collapse by 50%, you may be inclined to sell. And if it's one single bond of one issuer, then yeah, it can give you sleepless nights. That's why my advice would always be, if you look at high yield, if you look at tier one capital, stay with diversified vehicles, buy managers, quality managers, which good private banks can tell you about, but also buy them at the lowest cost possible price, like what our clients are doing, or we do for them. Yeah, that was important. And maybe as a last aspect of the slides, go back to the third slide about the global distributions of stock and bond markets. Yeah, here you will see. Here I want to talk a little bit about the local buyers. I mean, luckily I always have interns. Somehow they like to come to us. But these interns typically also tell me how they only buy Singapore REITs and yeah, some Singapore stocks. One of them bought OCBC, I think, which is not bad. I'm not saying you shouldn't buy these stocks. But on this graph, you can see that the world equity markets are still largely dominated by the US. 54% of global equities are American. So if you as an investor choose to not buy US stocks, that means you make a big bet against the global equity markets. And I mean, I think in Singapore, the sentiment isn't so negative, but in Germany, there are some people who think, oh, America is so domineering and they don't want to buy American stocks. They're actually hurting themselves because you can see Germany as, yeah, as big it may think it is, it's still only 3% of the global market cap. Yeah. So our advice is typically go global, go highly diversified, include everything, include emerging markets. And then you're really more or less on this 7 to 8% trajectory and don't have to worry too much about other stuff. Then the next slide is on bond markets. And here you can see that the bulk of the bond markets, actually what is quite interesting is that Japan is a big chunk of the global bond market, probably because it's an aging society. But the global bond markets are mostly dominated by government bonds. Especially in Europe, you see the corporate bond markets are only developing to a certain degree, also in Asia. And yeah, and that's just a fact that's important to know. And when we talk about bond markets, it still means mostly government bond markets. Even if in private banks, there's little talk about government bond markets. There's mostly talk about these high yielding bond markets, tier one capital, high yield bonds, Asian high yield. And I find this particularly problematic in Asia because the denomination of corporate bonds is very high. So you basically have to spend $250,000 or Sing dollars to buy just one bond. And I've seen portfolios in both Deutsche Bank and Standard Chartered Bank where some people who let them have 2 million, like entry-level private banking clients, they then buy 4 of these bonds and a couple of structured products, and these are really bad portfolios. I've seen it many times, but from my perspective, these are bad portfolios because they're overly risky, and if something bad happens in the market, the clients will have sleepless nights. Unless, I mean, if bonds get restructured, it's also pretty bad. But so I would advise you as the future generation of Singapore private bankers, do a better job. Don't give them just COCOs and FCMs. I think we've more or less covered the slides. Let's do Q&A now. Is that okay?
Yeah, we already have some questions coming in. So the first question is from Matthew. Can cryptocurrency be the future for remittance?
I mean, for payments and so on, I see no problem. Yeah, I was actually thinking earlier how we're going to talk about crypto. Yeah, because I personally think there's no need for any crypto. Yeah. So what came to my mind is an old, I think you call it Yusheng, right? Yusheng Gushe. In China, it's about Yigong Yushan. So it's basically a man who's removing a mountain with his family. Yeah. So I mean, in his case, I guess he needed to cross that mountain. So the whole family over several generations was removing this mountain. And I think that's what I think we see with crypto. There are a lot of people who believe that this is great and this is necessary and is the future. And I think if a lot of people believe, then this can actually happen. But what if there was another way to cross the mountain? Yeah. And for me, the question is, do we really need any of that? I mean, I can make a payment today in an ordinary system from Singapore to Europe, anywhere just like that. So I wonder why we need it. I don't get it. Maybe I'm too old already to get it, but so I guess my answer is yes. If the world wants this, if the younger generation of global financial market participants have faith in this system, in this decentralized systems, it will happen. But don't forget, there are a lot of, I mean, let's say, I'm not sure if you ever heard about coinage and so on in the early classes in finance lectures. Typically, it's always the sovereign that wants to earn the coinage. Yeah. So why would the sovereign, i.e., the various governments that we have, want to part with this opportunity to earn money by issuing currency? On top of that, what I also find remarkable, I mean, to me, this whole Bitcoin saga is quite fascinating, because I thought this genie was back in the bottle 2 years ago, but it's come back with a vengeance, because there's a new generation of believers. And what was I about to say? I've lost my train of thought. Because similar to this clean energy, because it's really not necessary. Oh yeah, on the coinage, yeah. So the thing is, no, coming back to it was last March. Okay, that's what I was about to say. We actually have evidence, and that's why I don't understand why Bitcoin came back. You probably all remember what happened last March. Supermarkets were empty. People were hoarding toilet paper. It was all about finding the stuff that you wanted to buy or whatever. There was no yogurt, there was no chicken. These were really the material needs that the world has in times of crisis. I don't recall anyone calling me, say, Mario, I want Bitcoin today. I need Bitcoin, or I need other crypto. And that's why I'm highly doubtful. I mean, I do agree, if a lot of people believe it, it will happen. But I'm wondering, why would it need to happen? I mean, there's already currency. Many years ago, they were using shells in the Pacific Islands, and there was gold, and there was silver, then there was copper, then there was paper. The purpose of money is to enable transfers, yeah? And transfers, if you ask me, need to happen with currencies or with an element that is not volatile. So let's say if you and I, Cherise, we do a property transaction now, and we do it in crypto, one of us will be a big loser. So so I think it's difficult. I mean, I'm not saying it cannot happen. Faith can move mountains, but I see no need for it. And I'm sometimes a bit amused if I see, because it started like 3 years ago, the whole hype was all about the West Coast, how Silicon Valley was driving this whole crypto craze, and China and Japan. And then I thought, okay, it's gone. People realize you really don't need it. But then it came back because some of these old New England asset managers from the East Coast started buying it. And I mean, of course, if everybody puts 1% of global assets into crypto, it will go up. It's very simple. But the question is, do you need it? I mean, in Europe, they were trying to create one currency for all of Europe. So the British opted out, the Swedish opted out, the Danish opted out. I find it difficult. And if I invest, the reason why I stay clearly away from crypto, but I also stay away from everything else. I don't like gold. I don't like any currency. I don't trust any currency, because I also don't really think that any government is able to look after my money well. So I tend to put money, if I have it, if I can save it, I put it in income generating assets. Yeah? I put it in properties, I put it in stocks. I even put it in wine, but that's more for fun. But at least, yeah, there's also some intrinsic value. Yeah. Okay, very long-winded answer. I think there can be a use for it, and if the volatility of these cryptocurrencies comes down over the years, then I think they may really play a role. The question is, if I want to buy a book anywhere in the world, do I need to buy this in crypto, or can't I just buy it in Sing dollars? I don't get it.
I hope that answers your question, Matthew. And next question by Jolene is, what traits do you think one should possess in order to have a successful career in wealth management?
As a relationship manager, or as an investment advisor, or as a product manager, or as a risk manager, compliance manager?
Jolene, are you here? Would you like to unmute yourself to clarify?
Hi, Mario. I was referring
Hello.
to. Hi, I was referring to risk manager.
Risk manager.
Yeah.
Yeah, risk manager, I think, so we're talking maybe market risk, or would you say more like governance, compliance, and so on and so forth? Let's say if it's market risk, these people tend to be very good with math and so on. They look at all these risk management system, value at risk. That's what was also one of the systems we were rolling out in my London project. I would say you really have to have a good command of numbers and but also I would say being highly skeptical, yeah, and being very distrusting. I think then you'll be a good risk manager, or at least not be so gullible and optimistic, and have your numbers ready. And at the same time, many of these systems, the whole value at risk system, I think is also questioned a lot. I think yes, I mean I'm also getting a daily value at risk report for the portfolio I'm running in Luxembourg. It's a small usage fund, but certain correlations, they just change massively if markets dry up or liquidity dries up. But yeah, I would say be more into numbers and data than into people. If you like to be with people, then maybe that's not for you. But if you really have a strong interest in numbers, in calculations, in modeling, financial modeling, then I think that would be something for you.
Thank you, Mario.
Does that help?
Yeah, it was very insightful.
A third question by Joshua. Hi, Mr. Becker. How would you go about pitching a portfolio composition to a client?
A portfolio composition. What I tend to do is in the very early stages of a client that I don't know or a prospect, I try to listen as much as I can. Because on one hand, and that's also in the appendix of this document, I think I've developed quite a simple way or a simplistic way of building portfolios, basically comprising of risk building blocks that would be mostly equity and safety building blocks, which would be mostly government bonds or in high quality investment grade bonds. And obviously over the time, I've had a lot of meetings. So I think I have a good sense of how I go about a client. But I think what's fundamental, especially also to newbies, and that's exactly also the risk when you work for a large organization that wants you to sell something. You need to listen to your client. My frustration with private banking was that it was not client-centric. It was really more about what did the organization want to do? What did the organization want to sell? What did the bankers want to earn? It was not really about the client. On top of that, unfortunately, the clients also often don't know what they want. So you really need to spend a lot of time in a dialogue with the client, listening well, understanding also the client context well. Yeah. So many of the questions, for example, we've created very complex suitability questionnaires, not because we're nosy, but because the more we understand from a client, the better we can create that portfolio. And then it almost everything falls in place. Yeah. That's why I tend to ask for investment time horizon. I tend to ask for target return. I tend to ask for, let's say, risk appetite. How do you feel if your bond falls 30%? How does that feel? Or can you imagine yourself having that kind of bond? And once I've asked all these questions and I've listened to the responses, the portfolio almost always falls in place. And then it's more about fine tuning. Then I present that portfolio and say, based on our discussion, this is what I think could work. First on an asset class basis, i.e. this could be the composition of stocks and bonds, and maybe something else if a client asks for something else. And then we go to the next level. Then the big question is always, do we go index investing, i.e. is it all about cost management because the client doesn't believe in active management or we don't? But since I do believe in active management on a certain level and in certain markets, I tend to present combinations of index investing and active management. Does it help, Joshua?
Hi, yeah, it helped a lot. Yeah, so I think a bit of follow-up. I was quite curious about the part between active management and investing in index funds. Like, what is your preference behind the two? And maybe if you do have a preference, what is like the main driving force behind it as well?
Yeah. I mean, we have this Bloomberg. There's another Joshua here who's currently an intern with us, where we do a lot of this comparison. Yeah. The benefit that we have is we really have nothing to sell. So our clients open an account at low cost with one of these partner banks, and then we just run the numbers. And some of what we find in our numbers is also stuff you can read in books. Actually, what I haven't included is a couple of book recommendations. My interns and graduate trainees, I tend to tell them about 3 books, which also discuss this. I can leave these titles later if you guys are interested. So long story short, there are each index is de facto also a portfolio. And there are good indices and there are bad indices, and then I think there are sensible index families, and then there are less so. But I would argue if you stay with the normal indices, let's say like the MSCI World or the S&P indices, they're typically well constructed, and in many markets it's very hard to beat these indices. In America, it's very difficult to find active managers that consistently beat indices. And I think what's also important is that we are honest about the benchmark. Let's say if a client says, not the client, but let's say if we're looking at an active manager that has a momentum strategy, then naturally we need to compare this manager with a momentum index and cannot just compare him with a normal index. So it should always be a fair comparison. So the observations I have is basically US indices are very hard to beat, and I tend to go via index investing. In Asia, let's say if you look at the long-term performance of the MSCI China, this index has undergone a lot of change. In the past, you could easily beat that index because it was high in state-owned enterprises. So in China, for the longest time, it was always better to go active because active managers could filter out these state-owned enterprises and had fantastic outperformance versus the index. This has now changed a little bit because now Tencent and Alibaba and all of these are in the MSCI China. So I think going forward, it may become more difficult. But since there's still a lot of stocks listed in the US, in Hong Kong, in China, I do look at active management in China for now. Naturally, always compare it to the various indices, CSI 300 and so on. And also the Hong Kong indices have changed a lot. The HSCEI used to be an index that I despised because it was just full of state-owned enterprises. But now it's also changed. It has a bit more tech stocks. And in Europe, MSCI Europe on a large cap basis is full of old economy stocks. So active management tends to outperform. I mean, not every active management, but we have about 3 to 5 active managers in Europe that we prefer to the MSCI Europe. In the small cap segment, it's more difficult to outperform in Europe. So there we may go via index solutions. I mean, we're trying to be as objective as we can be and as thorough as we can be in our analysis. And if you're particularly interested in that, have a look at this reflections document because it's loaded with these comparisons of active and passive or active and indexing. And I think what's also a big differentiator from our perspective, our clients always buy active managers at institutional share class level. So they never pay an upfront fee, and they never pay so-called distribution fees. Let's say if any of you were to go to a branch, you would probably have to, let's say for example, there's a beautiful India fund. It's from First Sentier India Subcon Fund, has done a terrific job, the manager. And our clients buy this without upfront fee and at annual management fees of about 0.9%. If you were to buy this fund via a branch bank in Singapore, you probably have to pay about 2% upfront fee, and you would buy a share class that has an annual management fee of about 1.8 to 2%. And obviously, if you have to pay that additional fees, the comparison between active and indexing is also quite different. I would say for a retail client, it may often be better to go via the index strategy. But for our clients and for an informed retail client with access to a good platform, the combination of active and indexing is probably still the way to go.
All right.
Was that helpful?
Yeah, it was very insightful. Thank you so much.
Just to like follow up with his question, just now you recommended like 3 books. Do you mind sharing the titles?
Yeah.
If you can recall them.
Yeah, I love these books. And although I must say that I'm being told they're not as easy to understand as I think they are, but they are timeless, and I would really encourage all of you who are looking to become investment managers or portfolio managers, look at these books. The first book is the guy wrote 2 books. Is from David Swanson. He's the chief investment officer of Yale University, and he's written one book which is a bit more technical. It's called Pioneering Portfolio Management. But he's written another book which I think is easier to digest for everyone. It's called Unconventional Success. And the reason why I like this book is because he really explains the benefit of the individual asset classes. What is a good asset class and what is sort of a not really a credible asset class. And he also discusses this active and indexing strategy. And what I find remarkable about this person, actually, I found it confusing before I understood it. Because in these 2 books, he's basically bashing the whole fund management industry. He basically says there's no point buying any mutual fund because they're all too expensive. But then if you read his annual reports of the Yale endowment, he always says that he buys 100% active. Yeah. So on one hand, he tells the world active is bad, and then he only does active. And the reason is quite simple: is fees. Yeah, he has access to active managers at fees that are close to the fees of index funds, and based on that, there is a little bit of relevant active management out there, and he obviously has access to this. So do our clients, and that was also my objective with the German website, to basically have everyone have access to these institutional share classes at low cost. Yeah, that's book number 1 and 2, if you want to call it that way. Then another book I love, it's from Jeremy Siegel. It's called Siegel, Siegel. It's called Stocks for the Long Run. And there's also, I think the current edition is the 7th edition. This book is wonderful because it tells you everything about the behavior of stock markets. And it also takes away the fear from the stock market that many people have. And the other book, which is the biography of John Bogle, the founder of Vanguard. It's called Stay the Course. And I like this book a lot because for once, I think he's a very admirable person. If you understand Vanguard, you will know that he has done a lot for the global retail investor. And in this book, he describes his own life, but he also describes how staying the course is so important. And that's also what you said earlier, all of you. You said greed and fear is detrimental to investment success. And he reiterates that how many times. So I would definitely recommend this book. There's another one, which I think you may also want to know. It's called Rich Dad, Poor Dad, but the very first edition of that. This gentleman has been writing too many books probably, but the very first book I think is very useful because it explains the difference between assets and liabilities, and good liabilities and bad liabilities. And I know Singaporeans love their properties, and this book can help with understanding this, how you build a portfolio of income generating assets, and how you don't.
Another question by Joel. He's thankful for an enjoyable presentation and you taking time off to share with us. He would like to ask about your thoughts on robo-advisors like Stashaway and its implication on private banking industry now and in the future. That's his first question.
Yeah. I think robo-advisors are fundamentally a very good idea because I think they have the ambition to educate the public and give low-cost access to to financial markets. I mean, I don't want to advertise too much, but the German website that I've created is basically, I would say it's a little bit like a robo-advisor, but the thing is, I firmly believe that if people understand certain simple facts, they also don't need a robo-advisor. They can actually do it all by themselves. Because what does a robo-advisor do, or most of the robo-advisors, and this is also why I personally don't have an account in any of those. I mean, apart from the fact that maybe I know it anyway, but my problem with them is most of them have no track record. They basically tell you, okay, this is us, this is our platform, this is low cost. It's all mostly about ETFs, although there are some robo-advisors who don't do ETFs. They do other things. And what you end up buying is basically a fund of ETFs without track record. And this makes me very uncomfortable because I know, and we have all the evidence through the facts is, I mean, what do they typically do? They come with 3 to 5 models ranging from very similar to how I do it with my colors. Blue is safe, red is risky, yellow is a combination, and so is green. But you can do that yourself. Let's say if you were to go, I mean, you will also get that reflections document, but you could just take the Vanguard Global Bond Fund and combine it with the Vanguard Global Stock Fund in certain ratios, 20, 80, 80, 20, 60, 40, 40, 60. And there you have your robo portfolio done just like that on a Friday afternoon. You don't need Stashaway for that. The only benefit that they may give you is that over time, I mean, don't get me wrong, I'm not against Stashaway as such, because many of these robos are exactly the same. Because they say, yeah, you have to do a lot of rebalancing. Rebalancing is so important. But if you're 20 years old, you should probably allow yourself to buy only an equity ETF or a high quality equity fund. You don't even need bonds. So you wouldn't need that. You could just have a simple equity product in a very low cost way, and you wouldn't need that. And given that they have no track record, this is actually that would be my biggest criticism. I don't know what I buy. They claim they're safe, they claim they have high returns, but time will tell. I guess in 10 years we can say whether the various robo strategies were effective. The question is, why do you want to wait for that? Because today we can already say the MSCI World Index has done this over the last 50 years. The Barclays Global Bond Index has done that over the last 40 years. We have the evidence of those indices, and we can combine them into a quality portfolio. So why, and we can buy them. I can tell you where to buy them for 0.15% or 0.2%. You don't have to pay Stashaway 0.5% to do that for you. You can earn that money yourself. And what I mean, I need to evidence that. But when they came out and they were all over the MRT with their stickers, I looked at it, and what I found very confusing was the fact that they have a Singapore dollar referenced audience, but they were only recommending US registered ETFs. And there we have a problem, because you already have to convert your Singapore dollar into US dollar, where they will probably collect a fee. I don't know how much it is, but there's an earning opportunity for them. And second of all, US registered ETFs have a bit of a estate tax risk. It may be tiny and faint risk. But normally, if I have a Sing dollar investor in front of me, I would recommend UCITS funds, which are registered in Luxembourg or Ireland or Hong Kong or Singapore, and that are Sing dollar denominated if available. So they may have changed that over time, but I felt there was a mismatch between the currency that the client holds and the portfolio they were recommending. I think if you do a little bit of work yourself, maybe 2 hours a month in the first year and then 2 hours a quarter in the second year, you can do that yourself. But it's definitely better than most branch banks, don't get me wrong. Yeah? It's a hybrid. It's like a hybrid car. It's not the perfect solution from my perspective, but it's a better solution.
The other question that Joel had was, he was quite interested in how your company prices its services, billable hours, a fixed price, or percentage of fund invested. The phase B structure, instead of having a commission-based one, aligns the interest, and he agrees that it's a huge step in the right direction. And he is curious about how customers are responding to your price structure, especially in Singapore.
Yeah. Yeah. I mean, I can be quite frank here. So also as future private bankers, you will be asked by your bosses to earn about 1% of the client assets that they have with you. Let's say you have a portfolio of clients, the bank will expect that you earn about 1% on these assets. And since banks can also do lending business, you could probably stretch that towards 1.5% or more. Our clients, since we know the pricing on the other side of the wall, we have negotiated prices with pretty much all private banks, external asset manager desks that we deem relevant for our clients, of between 0.2 to 0.3%. Let's say the Swiss banks, they're very used to this external asset manager family office model. They've been doing this for decades. So if a client is very large, or let's talk ordinary. The best solution I have for an entry-level millionaire is 0.2% plus a ticket fee. So if a client gives us 2 million, and we can only deal with accredited investors anyway, so this person will pay only 20 basis points, 0.2% on these 2 million. So that means the bank earns $4,000. Is that correct? $4,000 a year. Minimum is 5. So at least the bank gets 5. And the other banks are not very different from that. I think the most expensive banks we have, the client pays about 0.35%. So still much less than this 1+% that he typically pays in a private bank. Now coming to our fees, the benefit of having your own business is obviously I can price what I want. But at the same time, I should also be consistent so that it's a fair deal to everyone. So what I have done in the early years of the business, I had a friends and family pricing of 38 basis points. So the lucky number 38. So let's say if a client goes to the cheapest platform, pays me the 38 basis points, he basically pays 0.6% on his assets. The reason why it's like that is because I think, let's say if I was the client and somebody told me, okay, if you follow this balanced strategy, you should be able to earn 6 to 8%. Then I would think I wouldn't want to pay more than 10% of that, i.e. 0.6 to 0.8%. And this is also what I have in mind when I do the pricing. But then, of course, there are some very large clients. Yeah, we deal with one family that is even in the news and everything. They will find this too expensive, so I have to do this cheaper. And depending on the size, I may then also offer this for 0.2%. I mean, or I may even do it for a flat fee. Let's say if this is really a family that I want, I may then just say, okay, let's do a calculation on how much time I will spend, how much time the team will spend, and then maybe make a flat offer. I mean, it should be fair. We're looking at long-term relationships. We want to work with the clients really for as long as possible. And that requires that the client gets a fair deal, but we also get paid. I also don't want to feel like, oh, I'm really doing a lot of running around. I'm basically, one client told me I'm basically like a tailor, right? I'm tailoring everything around their lives. And I also deserve to get paid, yeah. So that's a little bit how we price it. Is that okay? More, you need more details to this answer?
Joel, I hope that answers your question.
It answers no, not yet.
No?
What
Would
do
you
you
like
need?
to clarify?
Okay.
Okay, that's great. For the rest who are still here, I think if you have any questions, then please unmute yourself if you are available, or you can just leave the questions in the comments box. Another question by Brian would be, how would you describe your typical day like?
Typical day. Well, I tend to always read the FT. Maybe depending on the time level, I browse through it or read it completely. I mean, yeah, I drive my kids to school because they go to the German European school. Then I come home. Then I'm getting ready for work. My wife still works at Standard Chartered Bank. Then we drive to the CBD together. Then, I mean, I always have a constant flow of emails that never stops. Wherever I am, I get to see emails, and I'm responding to emails. I'm getting chatted up, and I respond to chats. But that's sort of roughly the routine. And then I try to get as much done as I can until about 3:30, because then my kids come back from school, and I'm hoping. I mean, I'm always keen to spend time with them because it's really precious, and I would encourage you to enjoy if you have kids, and make time for them. And then then we have a little bit of family time until about 8 o'clock. Then the kids go to bed, and then I still have typically time sometimes until about midnight. I mean, I can decide what I do. The beauty of having your own company is you can choose when to do the work. I mean, that's not to say that the work is less. Maybe it's more, but since I'm distributing it across the day and the week, it never feels like work. I mean, hardly. I mean, sometimes it feels like work, but most of the time it doesn't feel like work. I feel I'm quite blessed, and I'm quite fortunate that I can have such a routine.
We have a question from Jolene. What are some major differences that you experience when you are working in Standard Chartered as compared to working for yourself now, actually, when you start your own company? So what are the differences?
I mean, obviously, if you have a lot of colleagues, there's a lot of exchange. But in all honesty, people go to work and not really to chat all the time. I would say what I do now is quite fitting for my life stage. But if, let's say, if I was your age, it's probably better to look to several things. Let's say if any of you were to join our company now, you may be a bit bored. I mean, on one hand, yes, you see a certain amount of hand-holding by an MD all the time. That's something that will probably never happen in a large organization. But you also work your way through a large organization. You learn things about the organization. You learn things about yourself, and I think that's valuable. And you should definitely do that. You should probably not go independent just like that. But over time, I think you will realize that the reason why you get paid in a large organization is because you're selling something, and often enough you're selling things that the client doesn't need. Initially, you will not know that. Yeah, I also didn't know that initially. But over time, you'll find this out. And then at some point, these feelings will be very strong. Because I think business is always good if both parties benefit, not just one side or even nobody. So I would say I totally enjoy what I do now. At the same time, I was also happy at Standard Chartered because and also at Deutsche Bank. I was always given the opportunity to contribute. I could manage my team the way I wanted to run it. So you can also have a lot of freedom in a large organization. But you just have to also find the right boss or the right mentor so that you will experience that freedom in a large organization. But it does exist. So definitely don't think it's not a good idea to join one of the private banks. And they also have to evolve. They need better new private bankers. And I would argue, I mean, I was here first time in 2000. I would say the current generation of private bankers is already much better than what we had in 2000. So the banks are also evolving.
I hope that answers your question, Julie. And if anyone else have any question, please feel free to just comment or just unmute yourself. Yeah. Or we might call it an early day if no one else have any more questions.
Yeah, Cherise?
Oh, there's one by Andrew. Speaking on mentors, how do you recommend going about finding one? He thinks that many professionals often mention that it is important, but in practice, he finds it harder than said than done. So
you're right. You're actually spot on. Every leader, CNBC, blah blah blah, they always talk about the mentors. Absolutely true. I think you have to reach out and be lucky. By that I mean, don't hesitate to send an email to somebody that you think you admire or you find interesting or intriguing. That person may really answer your email. Yeah, that's not to say that all of them will answer, but some may answer. And the reason why I say that is probably because, let's say, recently I learned that only about 50,000 people watch CNBC every day in all of Asia, which shocked me when I heard that number. And basically it means that what I do, most people in Asia find terribly boring. They don't find it interesting. So if somebody reaches out to me, like also what you guys did today, I find it interesting. So I get to talk about stuff that I like talking about. And mentors are also like that. Obviously, like I said, over time you will find out whether there's a certain chemistry, whether this potential mentor really has an interest in you or doesn't. You have to do a little bit of trial and error, yeah, almost a little bit like in a relationship, yeah. But dare to reach out. I'm always puzzled how many emails we get by people who would like to do an internship or somebody who has been there and has been recommended. If you don't try, it won't happen. If you try, it will not always happen, but it may happen. It happened for me. I mean, like this, for example, how I got my New York internship was I attended a speech of this perceived guru, and then but that was lucky then, yeah, because it was outside Cologne in Western Germany, and then the last train had left. But then somehow, I don't know, I told this guy that the last train had left. I also don't know why I did that. And then he said, oh, then you drive back with me in the car. I have a driver. And then all of a sudden, I ended up in the car of the guy who held the speech. And then he invited me to do that internship in New York. Yeah. and that's why I'm saying you can create your luck on a certain level, or sometimes you stumble across it. Be prepared to get a no or many no's, but But if you really like what you're looking for, let's say if you really like our industry and you talk to people, there will be people who will respond to you. And some of them will become your mentors. Good idea. And sometimes the mentors are at home. Sometimes it can be family members or uncles. Don't underestimate that there are people in your family who may really take a liking to you and want you to do well. So open your senses to people who are willing to help you.
There's a question from Hui Wei. So it's a follow-up question to the previous question asked by Julie. She's curious, what are the key traits, hard or soft skills that one should possess to thrive as a relationship manager in asset management or wealth management?
Yeah. I said about 20% of the bankers are really good. And that's, while it's not many, it's still 20%. And I would argue my wife is a very good relationship manager. And I've met others like her over time. And I think their common trait is that they really like people. They're genuinely interested in people. They don't get bored by asking questions and actively listen. I mean, I personally have an issue with active listening. I always have to force myself to listen better. But there are people who listen well by default because they're really curious about a lot of people. That's not to say they like all the people, but they're naturally curious about people and why they behave the way they behave. And if you have that trait, you'll be a fantastic relationship manager. And if you don't, you can learn. You may still be a good relationship manager.
We have another question by Crystal. May I ask what are the difference between okay, I'm not so sure about the acronym here. So Crystal, would you like to unmute yourself? Okay. Difference between an ultra high net worth private banker, I assume, at Morgan Stanley, JP Morgan, and as compared to other private banking or Goldman Sachs. So I think she's asking the difference between those high net worth private bankers at like Morgan Stanley as compared to maybe the lower end private bankers. I hope I got that right, Crystal. Yeah. Yes. So
The difference.
yes.
I think there are multiple facets to this question. Let's say, I mean, I would say in general, you could argue that the ones who work with the more competitive banks, they are more competitive people, they are better prepared, they may be working harder, and so on and so forth. And that's why it's more difficult to get to certain places. At the same time, what I found puzzling is that even, and that also goes for the clients. Yeah? Let's say the very competitive clients who really look at a bank as a utility, they will want to go to these very professional organizations where execution is fast, where pricing is competitive and all of these things, and where they have competitive, fast-paced, quickly executing counterparties. But then we're not dealing with a situation where we're looking at this traditional personalized private banking. Yeah, this is really about a professional client making use of a professional service. What I found very puzzling over time is that I've met very, very wealthy people who couldn't care less about how professional I was or what experience I had. or what title I had, they had the complete, or let's say their relationship manager had the complete trust of these people, yeah. And sometimes that started very early in the career, so that the client and that banker grew together, or that or they liked each other on a personal level, yeah. Because not every wealthy client, let's say a billionaire, would obviously qualify for ultra high net worth services, but not every billionaire is sophisticated. You cannot imagine how many or how a billionaire can still be very gullible and very unsophisticated, and so on and so forth, yeah. So what I was always trying to do with my team was try to create chemistry between people. I try to pair relationship managers with my team members and also clients, because ultimately private banking or personal banking is always about relationships. It's ultimately about long-term relationships, and it's working best if this group of people establishes trust that is then also not disappointed over time. Then things become very easy. The best private banking meeting is when you have lunch together, and then on the way out you sign the forms and everybody parts ways happily. If you get to that point as a relationship manager, all is good. But if you need a really long time to get your client's ear, or clients avoid you, then you can have the highest credentials and the most beautiful dress. It will not work. People are people. And that's why, maybe coming back to the robo advisors, and I see that also with my platform, the counterparty to the robo platform is a human being with skepticism, with trust issues. If these were robots, the robots would be running, ruling the world very fast and destroying the banks. But it won't happen so quickly, because the clients are made of flesh and are people, which is good and bad.
Okay, that answered Crystal's question well. And another question from Julene is, what is the biggest downside to being an RM?
Maybe to that question, I can answer what my wife told me the other day. My wife came across a very established banker many years ago at Standard Chartered Bank. And this gentleman is still with the bank as a relationship manager. And what she told me is that many years ago, he told her and her colleague, never give up your clients. Never give up your clients. Because what happens a lot in private banks is that, let's say, the good relationship managers at some point may hit a block in their career. And then they think they have to become a team leader to get that next title, to move from director to executive director or managing director. And obviously people want higher titles and not necessarily more pay. Higher title doesn't necessarily mean more pay. You can probably still have the same pay with a lower title. But the problem is, once you give up your book, once you give up your clients, you basically give up your life insurance, because then all of a sudden you're exposed. In the next downside, you're just an expensive senior executive who's managing people. And then in times of despair, everything is about revenues only, and cutting cost and cutting expensive people that are just managing, and they get killed faster. And I think that's the downside to an RM from an organizational perspective. There's another downside, of course, and I don't think we have to talk about that too much, is obviously if you do the wrong thing, right? If you deal with the wrong clients, you're trying to do fishy business, trying to there are a lot of things where wealthy people with bad intentions are trying to abuse young and gullible private bankers, and that's something you don't want to happen to you. I mean, obviously there's a lot of there are a lot of backstops and a lot of controls in the organizations, but but don't get tempted into either selling the wrong product or into, yeah, I don't know, helping a client to do things that are not supposed to be done. Because then you may be branded forever and you may lose your, you can never work in the industry anymore.
So I hope that answers your question, Julie. I think this will also conclude our question and answer portion. So do you have any concluding message for our future investors here? Any parting messages?
Well, I would say, I don't know how you looked at this session now. I hope you enjoyed it a little bit. I mean, I really love what I do. And I hope that you also find something that you find equally exciting. If it's private banking, we can really just stay in touch. I'm more than happy to answer questions beyond this. A good sentence I've been reading a couple of years ago is, dare to trust the markets. Don't doubt the markets. Have faith in a globally diversified equity strategy complemented with safe bonds in the right ratio, and you will look after your finances well, and you will advise clients well if you choose to be a banker. Maybe that could be a message.
Yeah, so thank you for your sharing today. I think a lot of us has learned something new. And please do not leave just yet. Please help us fill out a survey so that we can better serve you in the future. Yeah, you can just scan the QR code right here and fill out the form for us. And that will be all from Mr. Becker today and myself. So please help us to fill out the survey and you can take your leave from here. Yeah.
Thank you very much. All enjoy your respective weekends. Bye-bye.
Yes, you too. Have a good one. Bye-bye.
Bye-bye.